My take is that Main Street ends up paying for this problem because the ones that suffer the inflation in those goods and services that we see are rising well above official CPI are precisely the middle class and the lower classes. And the ones that don't benefit from asset prices going up, the ones that don't benefit from an improvement in credit prices because they barely can access credit, or they're already highly indebted. Even worse, they are highly indebted, but their salaries in real terms are not going up. Those are the people that end up being negatively affected. So it is not a surprise that the challenges for the lower and middle classes to achieve their goals in terms of financial wealth when monetary policy benefits disproportionately those that have access to the money creation.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Welcome to the Silver Doctors exclusive. Today I'm excited to have first-time guest, Mr. Daniel Lacalle. He's a PhD economist, fund manager, as well as a college professor and author. Today he's joining us to share his thoughts on the global economy, financial markets, and a variety of other subject matter. So Daniel, welcome to Silver Doctors.
Always a pleasure. How are you?
I am doing great, and I'm excited to have you on the show today and get your thoughts on what's going on. And so for those that may not know Daniel Lacalle, can you give them a little bit of your background and how you've arrived at this point in your career, and then we'll get into all the nitty-gritty.
Great. Well, my name is Daniel Lacalle, and I'm a PhD economist. I'm also a fund manager. I've been working in financial markets for, it's going to be 30 years now. And my experience is in portfolio construction, portfolio management, and as well as an economist. Right now, what I basically do is analyze the macro environment and give guidance about where I think that things might go. I'm the author of 3 books already published, Life in the Financial Markets, available on Wiley, and The Energy World is Flat, as well on Wiley. And the last one is called Escape from the Central Bank Trap. And forthcoming in March 2020 is Freedom or Equality. So plenty of things to read if you're interested.
Sounds good. So I appreciate you for sharing that. And so let's dive right into it. So I'm curious to find out your assessment on where we're at. And so we're approaching the end of 2019, a few weeks left. A lot of things are happening. A lot of things are rearing their head above the surface. So I'm curious, what concerns you the most, and what are you keeping an eye on directly at this current moment?
Well, if I would say what concerns me the most is that I see a little bit too much optimism in markets about change in global trade because of the phase 1 trade deal. I'm also concerned that because of the elections in the UK, many are starting to believe that everything is going to go fantastically well in the next year for the Eurozone. So a little bit of I see too much of this reflation trade coming back. The idea that the dollar will weaken, commodities will go up, emerging markets will go up, Europe is the opportunity. I think that we need to be a little bit more cautious than when we see things bottoming down to believe that it's a change of trend into a positive one.
Interesting. Now, I'm curious to get your thoughts. And so since you're over in the European area, you're in the EU, so I'll start there first. So you have Christine Lagarde, former IMF head person there. Now she's ECB head person. Give us your thoughts on her role. What will she do different than Mario Draghi, if not the same? How would you rank her and what are you expecting from her moving forward?
Yeah, Miss Lagarde is a very good professional, and she's very, very intelligent. I think that if we can expect something from her different from Mr. Draghi, will be that she is definitely a politician. This is the first time that the European Central Bank will have somebody with a political background and unquestionably political in the views about what should be done. And I think that will be a the main difference. The main difference. I think that obviously it is very likely that she will continue to defend extremely accommodative policies, and that she will continue to defend negative interest rates. She was a staunch defender of negative interest rates when she was at the IMF. And I think that she has already given a few hints about this more political ECB that she is aiming at. So I would say continuation and probably moving closer to what the Bank of Japan is, rather than the way in which, for example, the Federal Reserve acts.
Now, how do you think that will play out in an environment that's already relatively negative in most areas? And so I'm assuming more nations will also follow suit. And then how will that work out for the euro itself in this next decade when it comes to saving, investing, and things of that nature? I imagine that becomes a problem for fund managers to navigate these markets.
It is quite a challenge. It is quite a challenge as well, because unlike in the United States, in the Eurozone, the majority of savings is concentrated on deposits and in fixed income. A little bit on real estate, but fixed income and deposits are the key parts of savings of citizens. Therefore, those two areas are the ones in which financial repression, ECB actions, are affecting the most. Obviously, deposits get hurt by inflation and the devaluation of or at least the depreciation of the euro relative to other currencies. And obviously, fixed income investors are taking more and more risk in more challenging areas relative to what they used to, which was fundamentally sovereign bonds. So what I think is, how does this play? Well, the diagnosis of central banks about negative rates is the following, is that the reason why negative rates have to be implemented is because there's such low inflation that you need to penalize savings, and that there's an excess of savings which leads to low inflation. I think that diagnosis is incorrect. It's not just incorrect, there is absolutely no evidence that there is an excess of savings. The concept of savings glut is a joke. The percentage of savings relative to GDP in the Eurozone has not risen dramatically in the past 20 years. More importantly, it's mostly due to demographics. The Eurozone has a very challenging demographic trend. About 20% of the Eurozone population is over 60 years old. So the patterns of consumption and the patterns of investment are completely different as aging of the population affects the economy. The other problem for the Eurozone is technology, is that unlike the United States or China, the Eurozone does not have technology giants and technology leadership. That takes away a lot of the added value that comes into the economy from intellectual property and from the generation of new technologies and new products and services, which obviously detracts from growth. And at the same time, the corporate structure in Europe is fundamentally very, very, very small companies, and then a handful of very large industrial conglomerates, which basically makes it very challenging to increase productivity. So those problems are not solved by monetary policy, and increasing liquidity and lowering rates might disguise some of those problems, but it's not going to solve them, obviously.
Right. Now, as we head into 2020, I would imagine, I think I read some articles not long ago about Germany is either in a recession or heading towards a recession. So I imagine there's the figures will show that more nations are slowing down. Therefore, they're going to have to figure out how to create growth. And so on top of them not being able to meet inflation targets and all the things that they are currently working with, what are your thoughts on the recessionary environment in the EU, and how will policies have to be implemented to help out or to keep it from escalating beyond that region?
Yeah, if we look at why Germany has not entered into a recession, is fundamentally because in the Eurozone, the service sector remains certainly more robust than the manufacturing sector. The manufacturing sector all throughout the Eurozone is in contraction, and in the main economies certainly so. And the services sector keeps the economy sort of afloat. The second thing is government spending. government spending has risen in most of the Eurozone economies, and that has offset the reduction in investment and the reduction in the contribution of the external sector to GDP. As such, it is true that Germany and other countries have escaped recession, but it is also true that the quality of GDP has worsened and quite significantly. So we have to be very, very prudent about this recent bounce that we have seen in the macro data, both in PMIs, etc., because they might just be that, a bounce that we already saw, for example, at the beginning of 2018. And we need to see a very robust improvement in gross capital formation, in CapEx, and we need to see a very robust increase in consumption for us to believe that this recent sort of bounce back above the low levels is going to be sustained. So I would be quite cautious there. I need to see a lot more than a hint, because already in 2018, in 2017, and in 2016, we already had these sort of short-term mirages of growth expectation.
Yeah. Now you mentioned the word consumption, and so I know on this side of the water here, consumers aren't spending as freely as they used to due to the fact that disposable income is not there, overextension of debt in all types of areas of our lives. So consumption, which is the primary driver of our economy over here, is not really something I'm banking on myself. And so I imagine the EU is probably the same. What's the sentiment on the street as far as people actually continuing to live their lives the way they used to? Are they spending as much? What are some indicators there? What are your thoughts?
Well, the first difference between the United States and the Eurozone was demographic. We already mentioned that. And that obviously affects the trend of consumption, because aging of the population, it doesn't even matter that your disposable income has been relatively unchanged. Aging of the population affects consumption. The other point that I think is important is that in the Eurozone, we hear all the time from the ECB and from central planners that there's no inflation. Yet, what you have all over the Eurozone, in France, in Germany, in Spain, in numerous countries, you see a rising number of protests because of the rising cost of living. So it's interesting the difference between the official CPI, the inflation figures provided by Eurostat, and what consumers, citizens, see in their pockets every day, which goes back to your point. Unlike in the United States, Eurozone consumers are very prudent. They don't tend to take a lot of debt for consumption decisions. So that factor, that part of the consumption decision is not going to work in favor of the trends for the consumer. Disposable income is not improving either, because the tax wedge is rising, particularly the indirect tax wedge, which is an important factor. And because, as we mentioned, the reason why most of those protests are happening is because the non-replicable goods are rising much faster than wages and that the official figures of inflation. As such, it is very difficult to believe that we are going to see a big boost in consumption in the Eurozone. And if you look at, for example, I've been traveling all over Europe recently, and it coincided with the period of the famous Black Friday, no? And if you look at the activity in shops and the number of bags that people are carrying, it is not particularly overwhelming. It's just average, you know?
Yeah. So same thing on this side as well. So I'm curious to get your thoughts. Let's shift a little bit onto this side of the world. We currently have a lot of things happening here. What are your thoughts? What are your assessment on the repo market activity? And so it looks like it's going to continue on, billions upon billions. Is there an end to this? Is that quantitative easing or not?
Yeah, I find it interesting that people say that it's not quantitative easing because it's a temporary measure that will be unwinded very quickly. Well, we are already into the third month of it happening, and the Fed continues to pump money into the repo market. And the reason for it, I think, is is the reality of that the repo market crisis is a reflection of the fact that liquidity in the financial markets is lower than what the Federal Reserve and many market participants believe, and that the leverage is much higher. As such, the traditional providers of liquidity are unwilling to accept more assets like sovereign bonds, in order to for a very low rate, because they already have a lot of exposure to those assets. So what it tells me, at least, is that the market is not as strong in terms of leverage and in terms of liquidity as many banks and many central banks want us to believe. I think that it's the evidence that those that have liquidity hold on to it because they're aware at least of the risks of overvaluation and excess in the markets. And those that have liquidity are definitely not willing to accept as collaterals sovereign bonds. And as such, the Federal Reserve has to come in and buy those assets. So is it QE? Absolutely it is. Absolutely it is. It is a disguised quantitative easing. But the concept, the absolute concept of what quantitative easing is, which is that the central bank comes in as a provider of liquidity and is detracting the sovereign bonds out of the market, or some of those bonds out of the market, in order to facilitate that the credit transmission mechanism continues to flow. That is quantitative easing in every shape or form, maybe not in the name, or they don't want to call it like that, but it is.
Yeah. Now, one thing I find to be very interesting is that when this whole concept of quantitative easing was introduced, Ben Bernanke said it was a temporary measurement to provide, and that they'll be able to sell it off into the markets down the line when things normalize. So here we are 10 plus years later. They're adding to it. They attempted to raise rates. They attempted to lower quantitative tightening, wasn't able to do that. And so it looks like the current activity to me shows that there is no way of unwinding these emergency measures. So they're going to become the new norm. And so if they are the new norm, how does that play into a monetary base of the Federal Reserve, the reliability of the Federal Reserve note moving forward? If you know that the Federal Reserve will do whatever it takes to keep things as liquid as possible.
Yes. Well, we saw something that is quite extraordinary. You know? We saw that a Federal Reserve that was absolutely adamant about normalization, and that process of communication was made very clearly to markets over and over and over again, with every governor of the Federal Reserve, everybody saying it's going to happen gradually, etc. And when it started, just a small fall in asset prices, because yes, it's true that asset prices fell rapidly between October and December, but compared to the massive rise of equities and bonds in the previous years, it was just a small correction. No, just a small correction made everything change, and interestingly, made everything change when the two factors that monetary policy is supposed to be monitoring, which is unemployment and inflation, actually were getting closer and closer, and to not just the Federal Reserve target, but the best estimates of the Federal Reserve: core inflation at 2%, unemployment at 3.4%. So what we ended up seeing was that central banks care a lot about asset prices, and that central banks react dramatically and can do a massive U-turn precisely because of asset prices. As such, it is very likely that we will continue to see a very accommodative stance and a very aggressive stance in terms of monetary policy from central banks, because they've gone from being the providers of liquidity and the lenders of last resort to enablers of asset bubbles. And they don't know how to get away from that perverse incentive. So they prefer to accept the risk of rising asset prices as a sort of collateral damage that they can address further on down the line, rather than to make the whole thing crumble. And I think it's a big challenge.
Interesting. So I'm curious to get your thoughts on the fact that, we're talking about the ECB being accommodative, and we're talking about the Federal Reserve being accommodative. How does accommodation actually help Main Street? Or does it, or can it, or what? What's your thoughts on that?
I'm going to give you the official line, no? And then we can discuss my opinion. The official line is that Main Street benefits because it is cheaper to buy a house. It is easier to borrow on your credit card and make your shopping. It is also unemployment remains relatively stable in the case of the Eurozone, or comes down significantly in the case of the Federal Reserve. So Main Street sort of benefits from the stabilization of the economy. My take is that Main Street ends up paying for this problem, because the ones that suffer the inflation in those goods and services that we see are rising well above official CPI are precisely the middle class and the lower classes. And the ones that don't benefit from asset prices going up, the ones that don't benefit from an improvement in credit prices because they barely can access credit, or they're already highly indebted. Even worse, they are highly indebted, but their salaries in real terms are not going up. Those are the people that end up being negatively affected. See what I mean? So that is the reason why there's rising discontent in the parts of the economy that are not benefited by rising asset prices. So it is not a surprise that we see this trend of concern about inequality and about the challenges for the lower and middle classes to achieve their goals in terms of financial wealth when monetary policy benefits disproportionately those that have access to the money creation. So the ones that have access to debt and the ones that have assets already, no? So yes, you can buy a house at a lower rate, a lower interest rate today than 20 years ago, but you may not afford the house itself because prices of houses have gone way above what your salary capacity and your savings capacity can accept, no?
Wow, interesting. I'm curious to get your thoughts on the current impeachment process over here in the United States of America. How much does that possibly impact the financial world itself? Because once again, we got the leading nation at global, we're the head of everything as of its current moment, and there's so much disconnect and division in our political realm. How does that impact the markets?
I think that from the market perspective, one thing that I find, again, quite surprising is how quickly and how it is completely shrugging off the impeachment process. Regardless of the view of whether the impeachment is going to go ahead or not, or whether it has merit or not, that is a political debate. I find it at least concerning that market participants are simply shrugging off any impact whatsoever from that process. And it's an important process. I lived in the financial markets as well, the impeachment process of President Clinton. And it did generate a lot of uncertainty. And it did generate a lot of uncertainty because it is very, very difficult to pass a budget. It is very, very difficult to get things done in terms of legislation. It's not just the impeachment process itself. We can all sort of agree that there is a very high, or if not all, likelihood that the impeachment process will lead to nowhere. It's just how the government is sort of in a situation in which it cannot do almost anything in terms of fiscal and and domestic policies, and that should be a concern. So can this be one of the black swans of 2020? I don't know, because I find that the narrative in between market participants is almost that there is no question that President Trump will be reelected. and that there is no question that the impeachment process will not go ahead. As an investor, I like to work with probabilities. I don't like to work with absolutes, because absolutes rarely happen. And I remember precisely that was the reason why everybody got surprised with the election of President Trump, is that there was a massive confirmation bias in consensus saying, oh, this is done. It's going to be Senator Clinton who's going to win the elections. So we need to at least give some level of possibility to the impeachment happening, and we need to give some level of possibility to the election turning out differently, because that can be a driver of sentiment that changes the market very, very, very quickly. And it's one thing just that has to be in the investment process. I agree with most market participants that the likelihood of the impeachment going ahead is very, very low because of the composition of the House and the composition of the Senate. That is clear. No, that does not alter the fact that we have seen surprises in numerous occasions, and that if there's anything that a market participant today should not be including in the investment process is political certainty, because in Brazil, in Argentina, in Chile, in China, in India, in the Eurozone, in the UK, and in the US, we have examples of things happening exactly the opposite way of what consensus was expecting. So I think we need to at least give it a certain level of probability.
All right, understandable. Now, as we draw towards the end of our discussion this afternoon, I'm curious to get your thoughts on this next decade. So you threw out the word black swan. So I'm assuming anything can happen moving forward this new next decade. The expansion has been going on the longest. I think it's the longest officially in recorded history, to my knowledge. And so, of course, nothing lasts forever. Nothing good lasts forever. And so one day this thing will have to correct. What are you anticipating it when it corrects? And how serious will it be?
Well, if we look at a concept of the amount of monetary injection and fiscal injection that has been required to achieve such poor level of growth, but a very long expansion, it is very, very challenging to believe that when it turns, it will not take an absolutely disproportionate amount of fiscal and monetary injection just to try to bring it back to zero. What I think is that, and this is the difference between those that tell me that they see a very big recession coming in and a 2008 style crisis. This is where I sort of digress with many people. In escape from the central bank trap, what I say is that my belief is that when the bubble is created in sovereign bonds, the likelihood of the outcome is not a 2008 style crisis, i.e. a credit crunch, but a zombification stagnation process more similar to that of Japan, or what we are seeing in the Eurozone, which is that through monetary policy and fiscal policy, you continue to sort of navigate with virtually no growth, but rising debt and zombification of the economy. So my opinion is that it's likely to be that way, because if the slightest change, think about this. I mean, Germany with very, very low unemployment, 3.5%, I think it is, a little bit more. If Germany with such low level of unemployment, with fiscal surplus, with an economy that is fine, because of internal and external factors, is not growing, and you have every voice in consensus saying that they have to spend like crazy and that they have to do anything that it takes for, I don't know, 0.7% or 0.5% of growth, is that it looks like central planners will do anything it takes to address a small slowdown with aggressive policies. As such, in my opinion, it is very likely that if the US economy starts to slow down aggressively, it is slowing down now, but it's still, manufacturing is still on expansion. You have very low unemployment, many positive things in any case. But if it starts slowing down to the level that it starts to look like there's a recession ahead, I don't have any doubt that doesn't matter who is at the Federal Reserve, we will see negative rates in the United States.
Whew, negative rates in the United States is not a good thing for those that are parking funds aside, anticipating on them growing in a normal environment. And so that goes from the compound interest to probably compound inflation aspect. So the problems are plentiful. What are some strategies, some ideas, some solutions? Where does precious metals fall into this? What are your thoughts on the blockchain cryptocurrency space that we're kind of being steered into as well? What are your thoughts on all of those?
I think that in any strategy going forward, particularly considering what we call the bubble of everything, in which bonds, equities, commodities, everything has gone up almost in tandem, I think that having a strategy that is long precious metals, silver in particular, and I really like gold. Gold is money. And we need to understand that in many economies, we are talking about the United States, about the Eurozone, about developed economies, but in developing economies, the destruction of purchasing power via money printing that central banks are undertaking is enormous. Look at what's happening in Venezuela, in Iran, in Argentina, in so many other countries. So in those countries, demand for safe assets that sort of prevent or help savers and salaries avoid the destruction of purchasing power of the currency will continue to rise. As such, gold is, in my opinion, a very important factor there to have in a portfolio. Silver as well. I think that cryptocurrencies are a different animal. Cryptocurrencies you need to understand the volatility. You need to be happy with the level of volatility that they unquestionably have, because they are startup currencies, and their process of implementation as real currencies is slow, and some of them will fail, others will succeed. But I think that the reality of cryptocurrencies is that I remember that it was a few years ago that I was in a panel, and everybody else in the panel was telling me by 2017, Bitcoin will not exist. And there it is. By 2017, cryptocurrencies will have collapsed to zero. And there you have them. No? So I think that what is happening with cryptocurrencies is that they're slowly becoming an asset that people are accepting, and and that investors see that they are happy to take very high volatility, but at the same time they see that their quality as a hedge against purchasing power destruction of the currency if you're a Nigerian citizen or if you're an Argentine citizen, believe me, the volatility in Bitcoin might be high for us, but for them, compared to the volatility in their currency, it is maybe acceptable. So I think that what we are seeing is a slow process of normalization of cryptocurrencies as an alternative to fiat currencies. And obviously, in that process, there are bumps, and there will always be. But I think that an average investor should not have cryptocurrencies in a portfolio if that average investor is unwilling to tolerate volatility. If it's the kind of investor that calls me on a Thursday evening saying, what has happened to the markets when they're down 2%, that kind of investor should not be subject to that level of volatility. But if an investor that is looking at a very long-term process and that sees that gradual adaptation from startup currency, from almost nascent technologies to widely used currencies, and happy to take that journey, and then absolutely that is a possibility, but be aware of the volatility.
All right. Well said there. Daniel, it's been great having you here on Silver Doctors. Can you point people back in your direction so they can find out more about your books and your website and all the commentary work you do?
Thank you so much. Yes, absolutely. You can find me on Twitter. My account is at DLACALLE_IA. That is DLacalle_IA. My website, www.dlacalle.com, dlacalle.com. And very easy to find also my books in Amazon. You have all of them, and always happy to have a dialogue about whatever is happening in markets. Always fascinating.
Sounds good. Well, once again, Daniel, it's been great having you on Silver Doctors. Looking forward to continue to follow your work, as well as hopefully have you on in 2020, and we'll see where we're at and what's going on at that point. So once again, it's great having you join us here today. Thank you.
Let's have a great Christmas, everyone. Happy holidays. And let's continue the discussion in 2020.
Sounds good. Same to you.